Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook and your host for today's show. Today it is January 17th. It is a Wednesday. We did have a holiday in the markets on Monday. So if you did want to learn a little bit about volatility, we did make an educational video that we posted out on Monday that covers Vega, which is the Greek that tracks volatility. Previous to that, on other Mondays that we did not have trading, we actually went out and did Delta Gamma Theta. So we are to the good old Vega, which is the Rodney Dangerfield of the Greeks. It doesn't get the respect that it deserves, in my opinion. So if you're old enough to know that reference, maybe you chuckled just a little bit. With that said, I actually had a question on the show the last time that we taped, which would have been, I guess, 1 week from today, about IWM, because we had a long spread in on IWM. Well, we had a long straddle in, and we were, from looking at the chart, and I'm going to take a second here to get to where I need to be. Okay, so from looking at the chart, we thought that, well, now might be the time to do a long straddle. And when I look at the long straddle, which I see we have it up now, the area that we were concentrated on was the gap, like was this little fill, this little area. And somebody did ask, it was on, I guess it was on Friday's show, so it was less than a week. They did ask, well, why don't we just wait until Tuesday and see what happens over the weekend? And I just kind of talked about time decay because we were in a long straddle that was supposed to end at the end of the week. But this area right in here, and the Russell, this is the IWM, which tracks the Russell 2000 index. I should probably give a little bit more background. And let's go out, actually, let's pull this up and let's go out 1,000 days. See what happens here. And we can even go more. Let's go a couple thousand days. See if I can get back that far. And if you look at the Russell, it's just a crazy index in general. This is the IWM, but it's representative. So you see that it doesn't always follow a pattern. We had a nice little sideways channel here. Then the breakdown, strong move up, kind of danced around. And this was one of the most defined channels that I've seen in the Russell 2000 in quite some time. So we actually did a long straddle down here, because the danger of in the Russell, it's weird because you're in an index, so we have medium volatility, but the Russell is extremely volatile because it's dealing with small cap stocks. We are in earnings season, so that will add to some volatility. Because there are a lot of stocks in the Russell 2000 index, and a lot of them are small cap stocks, and they do react because a lot of times that's the only news you get on small cap companies is usually around earnings. Not always, but that's where you get the bulk of the news on some small caps. And so we did have that strong move the upside. So we did a long call and a long put, the long straddle. That worked out. Came up here, we had a head fake, and then a breakdown. And now if I zoom in here, what I was kind of hoping for is that we were going to fill this gap, and we did. But I said on Friday that I would want to be out of the trade if you stuck around. If you did not get out, then right here, we're now bumping up against the 20-day moving average. All the ducks are in a row. You got the 200-day, then the 50-day, and then the 20-day. This is the 50-day moving average. And we're right on that range. And I would definitely get out on the put side of things if I was long. We put this trade on right around 195. We're down at 189. 195 is where the market was at, right there when we first put the trade on. I would definitely sell the long put. We only got a few more days to expiration. You might get out of both of them if you would like, but get out of the put, and then you can maybe we come back within this range because we bounce a little bit off of the 50-day moving average. It's possible, but there you go. So I found that to be interesting because I did get that question, and if you heeded my advice, it wasn't as good as if you just kind of stayed the course, and that gap did eventually fill, and that's kind of what we were hoping for in the chart. All right, so IWM and Russell 2000, we're done with. I'm not going to look at that. Not going to look at the IWM anymore, especially with the just trading within that channel. If we do go all the way back down to the bottom of the range, I definitely want to look at doing either a long straddle, or maybe you just get gutsy and you just do a long call. But in the IWM, like I said, it's a strange underlying. It doesn't follow patterns very well. Every once in a while, it will establish one, and recently it did, and that's why I've been trading it more than I normally would. Okay. So today I'm just going to do something simple. We had some economic data. We got some retail sales news. Christmas was okay, is what the pundits were saying, in that they didn't blow away the numbers in the retail sales world, but they also didn't blow up the numbers and do horrible. So Christmas was okay, showing that the retail customers remain strong. And once again, it's the good news, bad news thing. Is the Fed okay with the fact that Christmas was okay, or are they not? And if you go and look at, and I'll take that time, let's take a peek at the FedWatch tool. If you see from the data that has been coming out this week, and we go to the March expiration, we did get a little bit of a drop in the probability of a Fed rate cut. And I think there's a little bit to do with some of the comments from some of the people that are in the conference, and made a few comments about not being as I don't know, excited about the concept of all the rate cuts that the marketplace is putting in. But here's what I want to highlight. Okay, so if we scroll down here, 1 month ago, it was at about a 62% chance of a rate cut. This week, it was at a 64, or 1 week ago, it was at a 64% chance. So fairly high chance based off of the way the Fed fund futures were trading. Now we're at a 55% chance. So there's still a higher probability that they'll cut than not cut based off of where the Fed fund futures are at. And if you look, if I scroll back up here, it's showing you, just to explain the chart a little bit, the current target rate is 525 by 550. Here's where the marketplace is anticipating that target rate will be based off of the way the futures are trading, which is 500 by 525, which is a 1/4 point cut. They even got a 1% chance that they might do a whole 50% cut. So interesting that it has came off. The marketplace has came down a little bit. Interest rates are once again drifting higher. Oil is drifting a little higher. We're seeing a little bit of that in the commodity space. And this, I was surprised to see that we came down so much on the probability of a 1/4 point rate cut in March, which March is still a little bit away. So we still got 14 days before the next meeting, which is going to be January 31st. And in that meeting, there's no probability of a rate, 2.5% chance that they might cut. So March is the target area. And there's a lot of debate from the pundits if they will be a rate cut or not. And the market data has definitely affected this probability this week. Okay, so the trend is to the downside a little bit. And because of that, and this is a little tough, we didn't have Options Guide TV on Monday, so we're putting together a trade on Wednesday. But I do want to do one short-term trade. Next week is going to be the kickoff of the mega caps. You have Tesla announcing, you have Netflix, which is part of the FANG group. That's usually the first one to announce. Then not far away, you have Apple, you have Amazon, and we'll be concentrating on some of those trades. We'll probably put some speculative trades in around earnings. But I still believe that there's a little bit of weakness in the marketplace. And we did a long butterfly with puts. I guess it was, I'm going to say 10 days ago or so. And we had to adjust the trade. The adjustment worked out great. We did an adjustment, brought in a net credit to the account. We were long the butterfly, rolled it into a short put spread, which was a bullish trade. The market kind of stayed flat, and that trade worked out. So we're not going to have as much time to adjust it. So we're going to put this trade on. We're going to hope that the trend is our friend overnight, and that we go to the downside. And if not, we will try to adjust, but it would be an adjustment on Thursday. Options Guide TV isn't till Friday. So I'll look at it and I'll tweet out the adjustment if we make the adjustment. But it's all about the fact that if the market continues to drift southward, we could probably get out of this trade on the open. It's going to be a little bit expensive to put on to start with, but I wanted to come up with a short-term speculative trade, waiting basically for the earnings in the mega cap tech next week so that we can talk about those trades. So that's what I'm going to look at today. So let's run back out. We'll run into the TradeHawk software. We'll jump over to the TradeHawk software. 1 second here. All right, there we have it. And let's go with SPX. Okay, so we'll do a very short-term trade. So this Friday, the date is the 19th. So we have January 19th expiration. We are trading at 11 implied volatility on those option contracts. So this might be a little bit expensive, but the way I'll normally set it up in the SPX is we're going to be doing the put butterfly. We're at 47.40. We'll be buying the most at the money, going down 20 points, selling those option contracts 2 times, and then going down another 20 points down to the 4,700 level and buying that once. And that will be our 1x2x1 butterfly. So it's going to be a little bit more expensive. If you do it on Monday, it would probably be a couple of bucks. Kind of curious actually exactly what we're going to end up paying for this. So 720, we're going to do this twice. We're going to go down to 4,700, and we're going to buy that. All right. So it's $4. So it's almost double. Because we didn't do it on Monday, it's almost double the cost to do it on Wednesday. So that will make our adjustment a little bit tougher. We're going to put this on for $4.25. We'll go $4.25. Let's make that the official paper trade. $4.25. I'm going to highlight that, and I'll pull this up a little bit so we can see it even better. All right. So we're looking at the January 19th expiration. That's the 17th. Okay. Maybe it's a little less than that. That'll be good. January 19th. Okay. 440. We're going to buy that. Sell 2 of these. And buy 1 of those. Yeah, 275. All right. Much better. All right. So we're paying only almost a buck more than we probably would have on a Monday if we would have set this trade up. So that makes the adjustment easier if the market moves against us. But it also shows you that if just the way time decay works, right? We set up that butterfly to start with just, it ended up being the 17th date. It didn't click over to the 19th. And we saw that it was trading for $4.75. That's the difference. That's how much time value, that's how time erosion works in the SPX. We were still around the strike. We weren't in the money on that option contract. So if the market just kind of stays where it's at, that's the potential. We're looking for 1 day's worth of time decay. If we can drift a little bit lower on this butterfly, this trade can be profitable by tomorrow, and we can take this trade off. We're just going to stick with the way the market is going, with the trend of the market. Going to do a 1 day trade, and if I have to adjust it, if the market's up 20 points or so tomorrow on the open, which would be a 1%, over 1% move, around a 1% move, then I would look at doing the adjustment. If not, if it's only going to go a smidgen, a little bit north, well, then we'll probably hang it out and check out the trade. But we're putting it on for $275. Yeah, that's going to be the midpoint. It's jumping all the way around. $275. if we can sell this for $5 or between $5 and $6, I'm going to get out of the trade. As a matter of fact, I would put in a good till canceled order today to sell this at $6 if it got to that. I would adjust it in the morning and probably take it off for anywhere between 5 and 6 if we can continue to see the market go to the downside. Right now, we're down about a half a percent, which is about 25 points. So if we're up about a 0.5% tomorrow on the open, we'd probably look at doing that adjustment, which would be about 25 points. All right, that's simple. So let's look at the what if calculator. We're going to send this to the what if calculator. And if you have any questions about the trade, please feel free to put them in the chat box. I'll try to address them here on Options Guy TV. If you have any questions about the IWM trade, or let me know if you did think about just staying in over the weekend on the IWM. We always propose things as a paper trade, but if you were interested, if you did stay in, it'd be interesting to know on that trade. But we're going to zoom in on this. We're going to pull this down. All right, so very short-term trade. If we put it on right now, there's not a lot of upside, not a lot of risk, but you have 2 days remaining, and this is why I like trading in the SPX. 4,000, 47, 4,800 point index. Options are going to be very expensive. Time decay is a real thing. If we get this market to start decaying, and it goes anywhere within this 40 points that we have set up in our put butterfly, then each day that goes by, this green line, which is our profit and loss graph right now, is going to start morphing towards the expiration graph, and it's going to take big jumps. Today is the day that you see the most time decay in, well, it's not the most, but you see a lot of time decay in the SPX options. It's usually from Wednesday to Thursday and from Thursday to Friday. Obviously, Friday at the end of the day trading, all that time premium has to go away. So that's what our butterfly is going to be. We're going to take a short-term speculative outlook, kind of waiting for earnings on next week's events. You know, we did have earnings this week in a lot of the financials, and they were mixed. Schwab was down a little bit. Interactive Brokers had a fairly decent earnings, and they were up a tad. Goldman Sachs beat, but then also went down a little bit. So mixed across the board on the banks, which have been doing well lately. So maybe it was a little buy the rumor, sell the news scenario that was going on with a few of the banks. All right. Let's go in back to the trading tab and let's read this off. We're buying to open one of the January 19th 4740 strike put options in the SPX, selling two of that same expiration 4720 puts in the SPX, and buying one of the 4700 puts, making our 1x2x1 butterfly. We're doing this for a net debit of $2.75 for the account. If we open up tomorrow about 0.5%, about as much as we're down, we're going to make an adjustment, roll into a put spread. And if not, well, then we're going to try to get out somewhere between 5 and 6 on this trade. Never really want to stick around trying to get that home run in a butterfly. 1 day's worth of time decay is a lot, but it also adds a lot of risk to the trade. So that's the way we're going to look at it. If we don't have any questions, which I don't see any, then that's going to be it for this edition of Options Guy TV. We'll see you this Friday. We'll see how this trade did. If I do make an adjustment, I will tweet it out. You can follow me at my handle, which is @BrianOverby. That's simple. All right. Thanks for coming, everyone.